From New York City for our viewers worldwide, I'm Dani Burger in for Jonathan Farrow. Happy Friday. It is 5 consecutive days of higher yields after dramatic 24 hours for inflation data. But even amid all that, equities are higher on the week. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
Coming up, futures looking to rebound after 2 days of declines. Treasuries, though, struggling to regain their footing as yields keep edging higher. And blowout wage results fueling bets for a BOJ rate hike. We begin with a big issue, looking ahead to Chairman Powell.
The Fed wants to cut, right? They're looking for an excuse to cut because they don't want to get to the point where they're passively tightening as opposed to, they don't want that to happen. But I think that this data does not give them any help in that. It makes it a little bit tougher for them to do it on the time frame that they were looking at. If this had been a more benign number, I think you would have seen that May call come back. And I don't think anyone was looking for anything in March. So they may just not say a whole lot about it, but we'll see.
Bloomberg's Michael McKee joins us now to help set the stage for next week's rate decision. Hey, Mike.
Well, we know there's not going to be much of a decision to make on rates. The question is, where does the Fed go in terms of its projections, particularly for the dot plot? Well, here's what Bloomberg survey of economists finds, that economists on Wall Street that we spoke with think that the Fed will cut rates starting in June, still 3 times this year, every other month, in June, in September, and in December, ending the year at 475. They will tweak their forecasts a little bit. The economists think that GDP is going to be stronger this year than the Fed's last summary of economic projections. No change in unemployment, but they do think that inflation's going to be a little bit higher this year. That's going to be one of the real question marks for the Fed is where do they put the unemployment rate? The Economist crystal ball sees the terminal rate very difficult to pin down. Where does the Fed end up with this loosening cycle if they get to it? The high figure is 6%, the low is 2%, so you could drive a truck through that. They think QT tapering will not be announced until June. Remember, Jay Powell said they're going to be talking about it at this meeting. It will start in July. Now, are we in recession or going to have one this year? 63% of the economists say no. Just 17% say yes. 21%, a fair amount, think that we will have just very low growth this year. And then finally, the question everybody wants answered, have we achieved a soft landing? Don't know what Jay Powell will say, but the economists we surveyed say no. By an overwhelming 73 to 27% margin, there is still more work to do.
I can't get over that. Someone thinks terminal rate should be at 6%, so we should be hiking at this point, Mike?
It is kind of strange, but there's a whole debate about where the terminal rate, the neutral rate is. Yeah. The median is 3.5. The Fed says 2.5. So there's still quite a difference between the economists and the Fed at this point.
Yeah, that will be interesting to work out, I guess, next year, maybe this year. Mike, thanks very much. Michael McKee there. All right, let's continue the conversation now with Morgan Stanley's Matt Hornbach and Invesco's Brian Levitt. Matt, you and the team wrote earlier this week that not much has changed. The dots are going to remain at 3. The summary of economic projections are going to be optimistic around that supply-driven growth. Given all of that, and we're now moved from about 4.1% to 4.3% on the 10-year yields, would you be buying this dip?
Thanks for having me on the program, Dani. I think certainly for medium to long-term investors, we think that these are great yield levels to take advantage of. So for the longer-term investors out there, yes, I think this would be a great dip to partake in. For the shorter-term investors, look, the issue is that economic data has been sending mixed signals. And just the data we've gotten this week and last with CPI and PPI surprising to the upside, but retail sales surprising to the downside. And bearing in mind, retail sales is a nominal figure that suggests that real retail sales were pretty horrible last month and weren't that great in January. So I would say the data's been mixed, and so we're advising a neutral stance towards benchmark duration for our shorter term investor community.
What do you make of that? Are we also going to get the same thing as Matt sees, the idea that long term you maybe want to be buying Brian, but in the short term, perhaps not with the mixed data?
It's going to be hard to time it, but I believe investors should be locking in the yields. And you look at all the appetite for money markets. It makes sense when investors see an inversion of the yield curve. They want to grab the 5% for 30 days. But these opportunities are not going to present themselves forever. It was only 2019 that people were begging for 4%, and you had to go out into high yield bonds or Russian sovereign debt to get 4%. Now you can get it in quality munis, quality corporates, longer maturity treasuries. So I would say lock the yields in. If you think back to November, December, when the market quickly priced in 6 rate cuts, the rates moved quickly. And you had a 10-year that was in the mid 3s before investors could even respond to it. So I would advise investors to not try to be too cute with this. Take advantage of the yields when they present themselves.
At the same time, though, as you were talking about, Matt, so we've gotten higher PPI, higher CPI, but at the same time, retail sales come in weak and maybe much weaker on a real level. We also had Empire Manufacturing coming in weaker. We also had import prices today coming in higher, which seemed to reignite that bond sell-off. Amid all of that, Michael Hartnett at Bank of America has been writing, inflation up, employment down, and U.S. government spending is off the charts. The macro is flipping from Goldilocks to stagflation. Matt, does stagflation need to be part of the conversation right now?
Not at all. not at all. So, I think when you look at the history of the U.S. economy, it's very rare that we actually have a situation that you would characterize as stagflationary. It did, in fact, occur during the pandemic when the demand for services fell, but the supply of services fell even further. That's a very rare occurrence in the U.S. economy where we get that type of combination of lower demand, but even lower supply. That's what you need to have a stagflationary environment. Otherwise, it's just a silly conversation that we would not be having with investors at this point.
Jamie Dimon is having it. Matt, are you calling Jamie Dimon silly? I know that's not what you're saying, but the conversation is kind of being had. Brian, I mean, should we be having it, or are you agreeing with Matt? It's silly. It doesn't make sense to have this conversation now.
I couldn't agree with Matt more. We should not be talking about stagflation. If you go back and you go back and look at 07, people were still having that conversation. The Fed should be raising rates in 2007. You could go find a lot of people talking about that in the middle of the year, that year. This is what happens. You always see this as ahead of the economy slowing down. I think that what you've seen more recently is consumer inflation. At least the momentum of it's been falling. Wages have been fine. You've got some import inflation right now because the cost of commodities have gone up a bit given what's going on in the world. But that slows the consumer. And so we're going to come in for a slowdown here on the economy. And the big debate is whether it's soft or hard. I still see a window to have a soft landing, but the Federal Reserve is going to have to respond. Having a funds rate of 5.25 when their preferred measure of inflation, the core personal consumption expenditure year over year, is 2.8. They're simply too tight. So no, this is not stagflation. Does the Fed have a risk of remaining too tight for too long? Possibly. But I still come back to first principles, which for me is post-peak inflation, peak tightening, peak rates, historically very good for risk assets over the next years.
And on that last point, Matt, I want to take that to you of how you judge how tight policy is at this moment, because we're, above 5% and nothing is broken. We're talking to Mike McKee about how someone out there thinks 6% should be the terminal rate. You have to admit this economy can handle more than 5%. So how do you judge exactly how tight we are and therefore how much the Fed should be cutting?
Yeah, Dani, I think, number one, you have to understand that monetary policy does not operate in a vacuum. It's never all else equal. And so if we're talking about what happened with monetary policy last year, you have to contextualize it with what happened with other big factors like fiscal policy or balance sheet policy, liquidity policy, if you will. And so when you contextualize monetary policy with a huge fiscal impulse, a huge liquidity impulse that occurred in 2023, it's very easy to understand why the restrictiveness that you would have otherwise thought monetary policy would behave with just didn't come through in the actual data. But that's where 2024 is going to be really different, Dani, is that we're going to lose the fiscal impulse, we're going to lose the liquidity impulse, and we're really going to be able to see how this economy stands up on its own. And ultimately the stance of monetary policy, I think, is restrictive, and so does the Fed.
Yeah, what difference does the fiscal element, Brian, to make of what Matt's saying? We are entering an election year. You have Joe Biden talking about tax hikes for corporations and individuals, though you might get some more looser type of policy from Trump, because if you come in, you want the economy to look better.
Yeah, but we won't see that until 2025. So, the market right now is focusing on, to Matt's point, less of a fiscal impulse. And so you boil it all together, less of a fiscal impulse, the consumer that seems to be slowing down a bit. This is an economy that's moderating. And to me, that means interest rates tend to go lower. It means that the market is going to start to assess whether it's a soft landing or a hard landing. And you may see some pullback in markets either way. Soft landing, you think of 94, 95, the markets fell 8, 9, 10%. Harder landing would be something worse than that. But either way, we look ahead, and I think the Fed should be looking ahead to normalizing policy. You start to normalize policy, steepen the yield curve, that tends to be a better backdrop for risk assets. So I think the Fed is a little bit behind, and I look forward to seeing them move.
Okay. I think we all are. Matt, Brian, stick around with us. Much more to discuss. But at the moment, let's look at some of the stocks that are moving ahead of the opening bell. With that is Abigail Doolittle. Hey, Abby.
Hey, Dani. And at this point, we do have the U.S. futures moving to the downside just a little bit. One stock that is certainly weighing is Adobe. Shares are down 12% this after they posted a weak sales forecast for the current quarter. They added AI tools to some of their main products recently. So the fact that the forecast is a little bit light, investors worried that some of the AI startups might be taking some share. Coinbase Global down 4.1% in sympathy with Bitcoin back below $70,000 per Bitcoin right now, down about 4%, right below $68,000 per Bitcoin. And then Micron, a bright spot, up 2.3%. Citi has raised its price target to $150, suggesting quite a bit of upside could be ahead from $95. That's a street high price target. It's based on AI, and it comes ahead of earnings next Wednesday. I would say that's a pretty high conviction call from Citi on Micron.
Yeah, some of those tech declines, though, dragging down the overall index, NASDAQ down 1/3%. Abby, thank you so much. Now, coming up, Japan's workers secured the highest pay hike in 3 decades.
The key factor is how we can extend the current momentum of wage increases, maybe next year and onward. So I think that will be happening because the key factor is huge labor shortage.
Could a rate hike be coming at the Bank of Japan? We're going to take a look at that next. This is Bloomberg.
The key factor is how we can extend the current momentum of wage increases, maybe next year and onward. So I think that will be happening because the key factor is huge labor shortage. Consumers should be more confident that the wage will be increasing furthermore, and we want to be the spearhead.
Japan's largest union group announces the largest pay hike for workers in over 30 years. That fuels bets that the BOJ will raise rates at their meeting next week. If they do so, it will be the first time since 2007. Bloomberg's Enda Curran joins us now for more. Enda, they have the pieces in place. They have the wage negotiations. So do they move?
Well, it would appear as though this is the final piece of the jigsaw now, Dani. Like you say, a gain of 5.28%, blowout, well above expectations, that multi-decade high that you mentioned. And it's worth remembering the broader context here. Remember, for years, Japan was all about deflation. For years, Abenomics and that huge monetary experiment was all about trying to get wages to increase sustainably. And here we go. It looks like Japanese wages are finally starting to take off. The question, of course, is how sustainable they will prove to be. But some of the corporate comments around the wage union outcomes overnight suggest that perhaps this demand is real. Now, in terms of the BOJ, this was the metric that everybody was looking to see when they might move, when they might pull out of negative territory and start to normalize policy. I think some economists are saying now it's kind of gotten to the point where if the BOJ didn't move next week, it's almost like they would send bigger jitters through markets, because markets would be confused about when exactly the BOJ will move. So a very strong wage gain reading, and it does seem, on the outside at least, to lend itself to the BOJ taking a step on policy.
Enda, appreciate it. That's Bloomberg's Enda Curran. Matt Hornbach and Brian Levitt are back with us. Brian, here we have stronger wages than expected, yet it is a weaker yen, and it has been a weaker yen for most of this week. Does it make sense to fade the BOJ speculation?
Well, the reason you have a weaker yen right now is, of course, we're recalibrating where the Federal Reserve is going to be as well. And so the expectation was the dollar would be moderating as the Fed starts to ease and the Bank of Japan starts to tighten. So that's a little bit of a recalibration here in the short term. Ultimately, the end of policy tightening environments, as rate differentials between the U.S. and other developed countries start to narrow, you typically see the strong dollar environment moderate, which would create a better backdrop for risk taking. So I don't think that story goes away, but it's a short-term recalibration, given that the Fed. Look, it was only a handful of weeks ago markets were pricing in 6 cuts. Now the last we see, 3 or 4. So that's a pretty big difference.
I mean, I would counter that and say the yen has also been weakening against the euro. It's not necessarily just a dollar story. And Matt, one of the arguments I've heard, this comes courtesy of Derek Halpenny of MUFG, saying that the risk is that the BOJ moves, but it's broadcast as a one and done, which means that any yen buying quickly turns into selling. Is that a risk that even if the BOJ does normalize, that's it and they stop there?
Well, it's certainly a risk. I highly doubt that they're going to broadcast a one and done type of a policy path looking forward. I mean, with these wage increases that we're seeing and the possibility of more to come in the following years, I do think it's prudent for the BOJ to paint a more optimistic picture on the economic outlook, and alongside that optimism is likely going to come higher interest rates. Now, when it comes to the yen, I think that the issue, in part for the time being, is that the markets are already pricing in a continuation of normalized rate policy. So in order to get the yen to move substantially on this BOJ meeting, you're going to need the market to reprice to an even higher path for short-term interest rates. And whether or not that happens, I think, will in part depend on the guidance that comes out of Governor Ueda. But but to Brian's point, and this is where I get to agree with Brian, we do think that the lion's share of the movement in dollar yen is going to come from the U.S. side,
right? And
so it remains to be seen how that plays out.
You guys are allowed to agree on this program. We love a little bit of agreement, but also some healthy disagreement too, because that's what makes the market. But maybe that's my part to play. Brian, on this idea that the market has already been pricing in a continuation of rate policy, it has been well telegraphed, at least from media reports and from what we've heard from BOJ policymakers looking at wages, that they want to start normalizing policy at some point. If it is well telegraphed, what does that mean for the repatriation of Japanese investors moving out of treasuries and into Japanese assets? Is that type of movement lessened by the fact that it has been so well telegraphed?
No, I don't think so. I mean, this has been in the, it may be telegraphed, but this is something that hasn't happened in so long. So it is a shift. The fact that you're seeing higher nominal growth in that part of the world for the first time in decades is a shift. And I would still expect to see markets move as a result of it.
And what about the stock market, Matt? I mean, we've seen huge gains, near records. Does it make a difference if Japan starts to normalize? Can the gains continue?
Well, yeah, I mean, and this holds a special place in my heart because that's where I started my career at Morgan Stanley is in our Tokyo office. And, the Nikkei was substantially below its 40,000 highs from the 80s. And now we're back. So I do think that the equity market is a story to focus on. it's not clear to me that 25 or 50 basis points higher in short-term interest rates is going to derail the trend in the equity complex in Japan. But what I do think is interesting is the interplay between dollar yen, the currency pair we were just talking about, and the Nikkei 225 or the Topix index for that matter, and kind of the relationship that those two assets play with one another. Because at the end of the day, the people that are buying the Nikkei at this point are largely from overseas locations, and not all of those investors want to take that currency risk. So we do see this feedback loop between higher Nikkei 225 and higher dollar yen, which, by the way, is another factor that I do think has helped keep the yen weaker than maybe you might have otherwise expected, Dani.
Matt, I'm so happy we were able to give you a throwback to your days in Japan, to your starting days at Morgan Stanley. What a lovely way to end it. Matt, Brian, we're going to have to end it there. Matt Hornbach and Brian Levitt, thank you so much. All right, just some more economic data hitting the terminal. Let's get over to Abigail Doolittle, who has the details. Hey, Abby.
Hey, Dani. Yes, we do indeed have some breaking news here. The U.S. February industrial production broke just moments ago, and it did rise 0.1% on a month-over-month basis. That's slightly better than the estimate for 0%. But where the bigger surprise is for a January revision, we are looking at a revision to down 0.5% from down a third of a percent. Excuse me. That is yes, and that is a revision that suggests that maybe January, the industrial production, that output from some of the industrial establishments, well, it was a little bit weaker than expected, Dani.
And that data having a big impact on equities, down about a third of 1%. More hot inflation data coming in. Abby, thank you so much. Now, coming up, we're going to get to your morning calls. And later, SoFi's Liz Young says don't fight the tape. She's going to join us at the opening bell to explain. This is Bloomberg. Get you your morning call to look at some of the analyst recommendations on Wall Street this morning. First up, Piper Sandler upgrades Rivian to overweight. They expect the company to benefit as excitement grows around new products. Next up, Bank of America upgrading Valero to buy. They see several upcoming catalysts in place to shift shares higher. Finally, Telsey upgrading Dollar General to outperform, highlighting the return of its CEO as a positive. Coming up, we're going to discuss the strength of the market with Liz Young of SoFi at the opening bell. This is Bloomberg. Your equity market just opening up this morning. We are extremely sensitive to the data. We had PPI come in hot yesterday. We just got import prices coming in hotter too, and industrial production being stronger than we had expected. The net effect of that is a quick turnaround in equities. The future session had been gaining. We now move to losses, down 0.6 for the S&P. NASDAQ dropped 0.7%, but elsewhere, we're getting ready for St. Paddy's Day. Jameson up and celebrating. When it comes to this bond market, it is a fifth day of higher yields. Yields moving up only by about 1.5 basis point for the 10-year. But what a trip we've had this week. We started the week below 4.1%. We are at 4.3%, 5 basis points away from testing the high of the year so far. Will the Fed reduce their dots next week? Does it matter if they go from 3 to 2? Euro dollar little change this morning as NYMEX crude moves lower. We're still, though, just under $81 a barrel. Okay, one of the stocks we need to be watching at the open, it is Adobe. Shares moving lower, sharply lower, I should say. They posted weaker than expected sales due to mounting AI competition. Abigail Doolittle has more. Hey, Abby.
Hey, Dani. Yeah, we're looking at a drop of more than 10%. This is the worst day since September 2022, so investors really not liking this. Now, relative to the quarter that was, it was okay. They came in slightly better, but relative to the guidance, to your point, it was weaker than expected, especially on the sales side. Now, it's not a huge miss, but it came in at the range range $5.25 billion to $5.3 billion. The estimate $5.31 billion. So again, a small miss. But to what you were saying in terms of AI, they of course are the leading software, longtime leader in software for creative performance professionals. And there has been some anxiety about what they'll do relative to AI pressure. So they have added some AI tools to some of their key products. So the fact that this forecast is coming in a little bit light with those expectations of being boosted by AI, suggesting that maybe some AI startups are taking some of their business. Now, on the other hand, Dani, the CEO is saying that the expectations were a little higher than maybe what they should have been. So either way, though, if it's the weakness that really is a disappointment around AI, or the bar was too high relative to the guidance, there's no question the stock down 12%. Again, the worst day going back to September of 2022.
Yeah. Tough stuff. Abby, thank you very much. Okay, let's stick with earnings. Ulta Beauty topped fourth quarter estimates, but results are getting overshadowed by a weaker outlook and softness from its cosmetics unit. Simone Foxman has more. Simone, this is interesting because it had been beauty, it had been cosmetics that was supporting all the consumer names. Not so in this case.
Yeah, and frankly, that narrative has been kind of going out of the market for a little while. But again, this retailer echoing what we've heard from many retailers over the past couple of weeks. Fourth quarter was great, but we're not so sure about the fiscal year. Oppenheimer saying, though, perhaps some of the weakness we're seeing this morning is because investor expectations were even higher than what the sell side estimates were. If you look at the fourth quarter here, everything pretty much ahead of estimates. Sales up 12% year on year. They were $3.6 billion. Comp sales up 2.5%. Earnings per share $8.08 versus an estimated $7.57. Even looking at the year forecast, most things were roughly in line with what the sell side had anticipated, though there were 2 weak points. Earnings per share expected to be $26.20 to $27 versus an estimated over $27, and margins a little weaker as well. Skincare remains the fastest growing category at Ulta Beauty, but William Blair pointing to that softness in those prestige cosmetics as the one clear negative in the print, talking about how more competition and also the back half weighted element of these forecasts likely raising some questions with investors this morning. That said, the sell side remains bullish, and you look at Oppenheimer telling clients to take advantage of some of the weakness today. However, we are seeing shares drop the most since May 2023, Dani.
Simone, thank you very much. Okay, another big mover that we need to watch this morning. It's Groupon. It's swung to a profit in the fourth quarter, but that's still not enough to get the shares moving higher. Isabel Lee has more. Isabel, it is a punishing market this morning.
I know, it's looking like it's a red across the board, and we have Groupon shares sinking 9%, and that's despite the company meeting estimates. So we have revenue coming in at $137.7 million. That's slightly higher than estimates, though 7% lower year on year. A big chunk of that came from North America, $99.9 million to be exact. International revenue made up the rest, but both are down year over year. But despite the revenue downturn, the company has managed to post a net income of $28.5 million, and that's a significant improvement from the loss we saw in the same period last year of around $54 million. So even if this is generally what you would say as a good report, investors aren't liking what they see. But the big thing I think that we can take away from this report is the company emerging from the liquidity concerns that plagued them last year. So it cast doubt on their future, but now we have the interim CEO saying that they're behind that. And for instance, the company now has operating cash flow of $55 million. It has free cash flow of $51 million. Although full year was negative at $78 million. Groupon's North America segment and international segment saw a decline in revenue year over year. And it's really just because of a decrease in demand. And, we have inflation coming up and people are feeling more pinched. So maybe that's why. But it really remains to be seen. Shares are now pairing some of its losses, though, but still down nearly 7%, Dani.
Isabel, thank you very much. Let's turn to tech now. Apple has acquired a Canadian AI startup ahead of its push into artificial intelligence this year. Bloomberg's Alex Webb has more. Alex, Apple looking to the north.
Yes, they've acquired this startup, Darwin AI. It's several dozen employees, so clearly not in any way transformational for Apple. It often does these relatively small acquisitions to boost either technology or just headcount. Now, don't forget, Apple was slightly left surprised when OpenAI released ChatGPT in November 2022. It took Apple and many other companies by surprise. As much as Apple does lots of things under the hood with AI, for example, with image recognition on your smartphone, with some of the autocorrect features, it doesn't have a big public-facing generative AI product. That's one of the reasons people suspect that it shut down its car project earlier this year. Lots and lots of very smart AI experts working on that. It is now moving them over to its core AI projects. The thing is, with this company, it does have some very interesting technology. It's about actually simplifying some of the AI processes. That could help Apple because it likes to do a lot of that stuff on the device rather than in the cloud. We don't fully know whether that's the reason. It could be as simple as what is known as an acqui-hire, getting top talent into your company by acquiring the company that employs you.
Alex, thank you very much. Our top talent of Bloomberg, Alex Webb. Now, shares are lower, equities are lower by about 0.5% for the S&P, but we are still a long ways away from actual ruin. The stock is still higher. The stock exchange is still higher on the week. And SoFi's Liz Young also notes that the S&P 500 is on its longest stretch of no 2% declines since 2018. She writes, this signal neither sends a warning sign nor is a clear-cut signal of further upward momentum. Instead, it's simply a testament to how strong the market has been for over a year, particularly during a time when many were expecting a recession. Liz joins us now. Liz, it is remarkable how this market has turned out so far this year. And it's made a lot of folks uncomfortable. That idea that we haven't had a correction, let alone a 2% decline in this stock market. So what do you say to clients who feel nervous and want to remain on the sidelines?
Well, the interesting part about where we are in the year right now, it's not even just the 2%, the days without a 2% correction. We are now at the longest yield curve inversion that we've ever seen. We just surpassed that record. We are on the doorstep of the longest wait between the last hike and the first cut, and we continue to push cuts out. So there's a lot going on in this cycle that feels elongated, and I think it's testing investors' patience. It's testing our resilience, but it's been really, like you said, remarkable that the market has held up this well. So what I would tell clients right now, and what I would tell people who are nervous, because frankly, I've been one of them who's been nervous, and all the way through 2023 was worried about there being some sort of crack in the economic data that would send us over the edge, and it just never came. Now, that doesn't mean that it's not going to come eventually, but in the meantime, momentum is a very powerful force. And I think what's going on right now is obviously we're seeing a breather in some of those big cap tech names, some of the ones that drove the market all the way through 2023, which is natural. I don't think you'd find many people who said that those names were attractively valued at this point, and they're obviously very crowded trades. But what's happening is investors still have risk appetite. There hasn't been anything yet that's convinced them that risk appetite should go away. So even when they're taking some money out of those winners, they're just rotating into other parts of the market, which is sending the signal that we're broadening out and that the market is stronger than many thought it would be.
I have to say, Liz, it is quite remarkable that $56 billion flowed into U.S. equity funds over the past week, which would be a record. And if I were to tell you that and say in the same breath that this is happening, that money market funds hit yet another record also this week, the third consecutive week we've seen a record in money market funds, that those two things are coexisting together, you probably wouldn't have believed it. So is cash more sticky than we thought? If people are fine chasing risk, but in the same breath, fine parking some of and a lot of their money in money market funds?
Well, I do think cash is sticky at this level of rates. And as we continue to get stronger economic data and inflation data that surprises to the upside, even if just a little bit, you see the stickiness in rates, which keeps what you're getting paid to sit in cash higher. So it is a rational investment decision in some ways to stay in cash and get paid while you wait and while you try to figure out where the opportunities are. What's interesting about this point right now is that there's this huge debate over whether or not we are in a position of late cycle euphoria, meaning people are engaging in the FOMO trade. The big caps are leading. You've got this kind of risk appetite that is not necessarily unhinged, but perhaps not all that supported. Or are we in a mid-cycle expansion phase, meaning that the economy continues to grow? We have a long ways to go before the business cycle is over. And that debate, you could make the case for either side pretty easily. You could find the data to make the case for either side. I am on the side that I think we are more late cycle euphoria. And this late cycle portion could last a very long time and already has lasted a very long time. But that doesn't mean that just because it's lasted a long time that we have gone back to be early or mid-cycle.
If we are in this stage of late cycle euphoria, Liz, does that mean the hope for trades like value, which by some measures is its cheapest in 20 years, that small caps tumbling 2% yesterday continues to underperform large caps, that trade can't really take place? Because usually you need that economic upswing to really get into those names that are more cyclical and are cheaper.
Well, you're seeing some appetite for those names. You've seen industrial stocks do really, really well. You've seen energy stocks start to come off the mat. You've seen materials come off the mat. I think that's more due to the fact that inflation has surprised to the upside. But you are seeing some of those cyclical names catch a bid. The small cap piece is what continues to perplex me and what continues to worry me, because you do want small caps to confirm the move upward in the broader market. Small caps employ 50 to 60% of the American economy, and they are more financed by debt. So if small caps can't quite get up above that certain line that they've been trying to get above, there's a resistance line that they've been trying to get above for a long time, and they can't quite break above it and stay there, that's something that still sends the signal, like I said before, that we're more late cycle than mid cycle. If we were in the mid part of the cycle, the things that I would expect to see are an unemployment rate that's higher than it is now, maybe not concerning, but higher than it is now and falling. And I would expect things like small cap value to be leading the way. But even when we saw that rally in small caps, starting at the end of the year and into the beginning of this year, it was largely led by small cap growth on the heels of the healthcare rally and the weight loss theme. So it's not the same things that you would expect to be leading us out of an earlier mid-cycle behavior.
If we are, again, in a late cycle, more euphoric type stage, Liz, and it's extended, that makes it quite difficult to try to hedge yourself, because the idea is that it is extended. It can go on for some period, so hedges end up not paying off. What we've seen is that the right tail has become the new left tail. Folks are more willing to hedge upside risk than they are downside risk. How are you thinking about hedging these markets and hedging gains and potential losses?
Well, I think that investors who still have a position in cash that's paying a high percentage is a good way to hedge it. And you still can look at treasuries. I know that sounds like such a snore, but you look at treasuries, particularly on the short end of the curve. If we are approaching, and perhaps it's getting further out, but at some point we are approaching the first Fed cut, the short end of that treasury curve has to come down when that becomes closer into view. So you do want to hedge with some of those things. I think classic defensives are also important to have a position in. So things like utilities and staples, not to mention when rates do finally come down, you probably want to own stocks that will pay a healthy dividend, which is consumer staples, utilities, even some energy stocks. So I think you can look at those as a hedge. And the last thing I would say is, if we are in fact late cycle, and if there is some kind of macro data or macro shock that comes in and disrupts the cycle or disrupts the upside in stocks, the thing about that type of period is that correlation goes up. So most asset classes will go down together, at least for a brief period of time. It's difficult to find anywhere to hide. So you do want to make sure that you have exposure to the places that maybe wouldn't move, things like cash, for example, or things like treasuries that would move but act as a good hedge.
Yeah, the hedge of the fire sale. Liz, thank you so much. That is SoFi's Liz Young. Also worth mentioning while we're talking about options, it is triple witching today. We're going to get $5.3 trillion worth of options expiring. Perhaps some of the reason we're seeing shakiness in stocks. Your equities this morning on the NASDAQ down nearly 1%, the S&P down 0.5%. Coming up on the program, the TikTok bill is now stalling in the Senate.
Nobody's talking about a ban. We're talking about transferring the ownership and the algorithm to some other control that's not Chinese.
The latest on TikTok's troubles in Washington next. This is Bloomberg.
But I think we need to get this done. And what, again, we need to make clear is nobody's talking about a ban. We're talking about transferring the ownership and the algorithm to some other control that's not Chinese.
That was Democratic Senator Mark Warner of Virginia speaking yesterday on Bloomberg. The TikTok bill, the one that passed in the House, now faces an uncertain fate in the Senate. Lawmakers are walking back the idea of fast-tracking the legislation that would force the app's Chinese owner to sell it or face a ban. Bloomberg's Anne-Marie Hordern joins us now. So we get this quickly going through the House, and in the Senate, it just stalls. I guess Steve Mnuchin might have to wait a while longer if he wants to buy it.
Well, I'm glad you brought up Steve Mnuchin and potentially this consortium he might put together to buy it, because what we heard there from Senator Warner, who is the chair of the Senate Intel Committee, is kind of coming up against what TikTok is saying. TikTok is trying to tell their individuals who like to use this platform, the 170 million Americans, that this will be a ban. And what Senator Warner said is that's not true. We don't want this to be seen as a ban. We want it to be a divestiture. So you have to remember, this is the context that is at play here. TikTok wants those viewers to know that this is going to be a ban. The Senate's like, actually, we just want to find a buyer. What you can see in the Senate, though, there's a lot of issues that are being raised. This gives too much leeway to the president. What happens potentially? Does this have any issue with First Amendment for free speech? So basically what's going to happen, Dani, the House moved really quickly. The Senate, the upper chamber, they will remind you, is going to take their time and look through this bill. Potentially, we could see some amendments and some changes.
And we also have to talk about what happened about an hour ago. You broke on your show Surveillance that Netanyahu has approved an operation for Rafah, that is evacuating civilians and then starting a ground operation. There's been a lot of talk on the U.S. side from this. Biden has talked about it. We can debate what color the line he drew on this was, but we heard from Chuck Schumer yesterday saying that Israelis need to replace Netanyahu. How much more awkward and tense does it make the approval of invading Rafah?
Well, yeah, this is going to be incredibly intense between the ties between Netanyahu and the Biden administration, especially off the heels of that scathing speech from Senator Schumer yesterday, saying that basically there's no path forward in Israel with Netanyahu at the helm. What we have here is Netanyahu coming out from the prime minister office talking about the operation for a ground invasion advancing. First, that means evacuating those civilians. Remember, Dani, when the Israelis went into Gaza in the north, a lot of those civilians went to this city of Rafah in the south. And now the United States said weeks ago, the Israelis need a credible plan to make sure that those civilians are out of harm's way before they go into Rafah. And the president also signaled Rafah could be a red line. I like that you say it was this nuanced approach to a red line, because it was. The president said there is a red line, but at the same time he also said there's no red line when it comes to weapons for Israel, when it comes to the defense of Israel, the Iron Dome. So potentially what Aaron David Miller has talked about is this pink line. But certainly this is going to ratchet up tensions we have seen between Jerusalem and Washington. And amongst all of this, you have a ceasefire negotiation ongoing for those hostages that remain in Hamas's custody.
Yeah, I mean, look, whether you're talking about a line, whether it's red or pink, Biden talked about a line, so it gets awkward if the line gets crossed and nothing happens. Anne-Marie, thank you so much. As always, that's Bloomberg's Anne-Marie Hordern. Okay, let's get to some of the sector price action this morning. With that is Bloomberg's Abigail Doolittle. Hey, Abby.
Hey, Dani. Well, we do, in fact, have this decline for the S&P 500 down about 0.6%. So not surprisingly, it is a bearish tone for sectors, tech being the worst sector, down 1.3%, consumer discretionary, and of course, Adobe, one of those tech stocks that is weighing, and then healthcare, communication services. To the upside, energy, materials, utilities, industrials. You were mentioning earlier that it is triple witching and the rebalancing. On that, we do have the stocks lower being dragged on by NVIDIA. Lots of talk about what that's going to look like, the expiration for NVIDIA, and then Supermicro, Computer, and Deckers, well, they're being added. And we do have some interesting breaking news to talk about, too, Dani. If you recall last year, there was the lawsuit against the National Association of Realtors and other realtors around the way commissions were calculated. There was an award of greater than $1 billion. They have, according to the New York Times and the Wall Street Journal, is what I'm seeing right now, agreed to settle that case, to slash commissions to settle the lawsuits. Right now, the National Association of Realtors will pay, according to the New York Times, $418 million in damages, and will amend several rules that housing experts say will drive down housing costs. We'll certainly be covering this story as it develops through the day, Dani.
Abigail, thank you very much. Okay, coming up, the market-moving events that you need to be watching. That's next in our Trading Diary here on Bloomberg. Now for your trading diary. This is what you need to be watching today and next week. But first up today, it is UMich consumer sentiment coming out at the top of the next hour. Monday, NVIDIA's annual AI conference begins. Bank of America called it Woodstock for AI. Tuesday, the Bank of Japan kicks off a slew of central bank decisions. And then Wednesday, it's the Fed's turn. Plus, we're going to get a Chair Powell news conference shortly after. Thursday, we're going to hear from the Bank of England. So it is a big week next week, though equities are down this morning. It is triple witching. We did have hotter data. All of that pressuring markets, yields up for a fifth consecutive day. This is Bloomberg.